The transformation of public sector banks or PSB is a must before undertaking any privatization exercise. The objective and the roadmap for privatization should be to create some value and not to sell them at the current dirt cheap price. Let us understand the PSB universe and the likely candidate for privatization. The public sector banks control 2/3 of the Indian banking in terms of loans and advances. The government has already created 5 large public sector banks by merging over a dozen banks. These are SBI, Bank of Baroda, Punjab National Bank, Canara Bank and Union Bank of India. The government's new stated policy is to have not more than 4 PSUs in every strategic sector, which in a way should also apply to the public sector banks. These 5 PSBs with large balance sheet size are definitely not on the government's radar for privatization. The second set of PSBs are like Bank of India and the Central Bank of India, which are operating as independent banks with no mergers. The government wants these 2 banks to consolidate their national presence. These 2 banks could be the likely candidate for privatization. There is also a third set of mid-sized banks which include Indian Overseas Bank, Bank of Maharashtra, UCO Bank and the Punjab and Sindh Bank. The government had earlier asked these banks to focus more on deepening their regional presence. These banks are also high on the priority list of privatization. So there are basically 5 banks which could be available for privatization. Bank of India, Central Bank of India, Indian Overseas Bank, Bank of Maharashtra, UCO Bank and Punjab and Sindh Bank. The big question is how the government is going to pick up these banks for a sell-off and what should be the roadmap for privatization. Currently, these banks are available at a dirt cheap valuation which doesn't call for an outright sale. The price to book, which is a valuation metric and compares the current market price to its book value, is very low for these banks. The private sector Kotak Mahindra Bank gets one of the highest price to book value of over 5 times in the stock market. The largest private bank HDFC Bank enjoys a price to book of over 3 times. The country's largest bank SBI has a price to book of close to 1 time. Now let's look at the price to book of these 6 PSBs. Punjab and Sindh Bank has the lowest price to book value of 0.17 times. Bank of India, which has the largest balance sheet of Rs 6.5 lakh crore amongst these 6 banks, gets a price to book of only 0.3 times. Let's study the asset versus market cap comparison. The combined balance sheet size of these 6 banks or 6 PSBs is comparable to the private sector HDFC banks, which has assets of over 16 lakh crore. But the market capitalization or the valuation of HDFC Bank at Rs 5.5 lakh crore is 9 times more than the combined market cap of these 6 PSBs. The government shouldn't sell any stake at these current levels. Out of the 6 banks, there are currently 3 weak banks which are under the RBI's prompt corrective action because of lower capital, higher NPAs and losses in the books. These are Indian Overseas Bank, Central Bank of India and UCO Bank. So these banks have to come out from the RBI PCA before any sale can happen in these banks. So selling these banks at the current level or the current state doesn't make any sense. The buyers will also have apprehension and fear over the correct position of the asset quality. Clearly, they will be a bit reluctant to buy without knowing the true picture of the NPAs. Similarly, there are hidden assets in the PSBs in the form of real estate in prime location. These should be monetized as large branches are no longer required. The digital anyway doesn't require a huge branch network. These banks also have non-core assets which can be offloaded before privatizing them. Last but not the least, there is a huge customer franchise which could be exploited for cross-selling. The entire cost model can be relooked at, which will improve operation profitability. The first step should be to invite top-notch private professional to run the bank. The board should be revamped to include experts from different areas where these banks are very weak. Take for example, experts from technology and digital area, risk management, cyber security and legal. The current government did experiment with Bank of Baroda by hiring outside expert like PS Jayakumar an ex-City banker turned entrepreneur who was appointed as MD CEO of the bank. Ravi Venkatesan, former chairman of Microsoft India and ex-independent director of Infosys, was also appointed as chairman. These professionals did transform the bank in terms of system, processes, people, product, etc. But the entire exercise was left midway as the government announced the merger of Vijaya Bank and Dana Bank with the Bank of Baroda. The government also didn't extend these two outside professionals' tenure to give them enough time to run the bank. The first step should be to hand over the banks to outside professionals. The government can either pick up one of the 6 banks or a couple of banks to create a template of change before privatization. This will help in bridging the gaps in terms of technology, people, products, and also create value for the shareholders. The next step should be a gradual reduction in the government shareholding in stages. The current government holding in these banks is between 83% to as high as 95%. In the first phase, the government should bring its holding down to maybe 52%. The next stage should be to reduce it to 26%. In fact, the government should remain as investor with 26% in these banks. This should be done to protect the interests of the employees and also wait for an upside in valuation in case of a major turnaround by the new buyer. Clearly, any privatization exercise in PSBs without transformation would mean selling these banks at a junk value. The government won't get the right value. The employees would be left feeling shortchanged, and the new promoter or buyer would be exposed to unknown or hidden risk in these banks.